started talking about Bitcoin and beyond and how to trade using cryptocurrency CFDs. Now, this webinar will provide traders with a guide to trade cryptocurrency CFDs. We will explore the major cryptocurrencies today, as well as the reasons why you should consider trading CFDs on cryptocurrencies. Now, cryptocurrencies are nothing new, and a lot of people are just getting into them, but they've actually been around for now. Bitcoin's been around for about 12 years. And neither are cryptocurrency CFDs. They've grown in popularity. They're available in a lot more places. And now, a lot of regulated platforms are allowed to offer these because the regulators have permitted them. But most people, and most smart people, stay, if you're trading CFDs, with Bitcoin, Ripple, Ethereum, and maybe Litecoin. Because remember, you need to trade where there is volume. You need to trade where there's some established criteria, where the coins aren't so small that a move by a whale could have a big effect, or that somebody can control the price by making moves. Okay. And we want to keep things on the up and up. Now, even though many people still are unaware that cryptocurrencies can be traded through CFDs, more and more people that trade with platforms, I've seen them on their platform, and they've gotten involved. Because trading a cryptocurrency CFD is the same as trading a Forex. You're trading one asset versus another. In most cases, you're trading Bitcoin against the US dollar. And when you hear Bitcoin hit $19,000 today, they're talking about Bitcoin against the dollar, because the value of Bitcoin has to be in some format. Now, if you're in Europe, you might see Bitcoin quoted as the euro, but it's predominantly quoted, or all cryptocurrencies, as against the US dollar. Just like you see the price of gold. Gold is usually quoted in US dollars, but you can see gold euro. Now, cryptocurrencies, let's go. We're not going to spend a great deal of time going into the background. We're not going to spend a great deal of time talking about miners and all the other kinds of, because if you don't know that, you got to find out. Today, we're talking about trading these cryptocurrencies in a CFD format. Now, cryptocurrency is a type of a digital asset or digital currency. It does not exist in the physical sense, as in the case with regular fiat currencies. This is a dollar and a euro, where you can get them at the bank, put them in your pocket. Cryptocurrencies are not regulated or managed by any financial authority or bank in the same way as traditional money, but it is mostly self-regulated using various encryption techniques, meaning that in the US central bank has control of the value of the dollar, how many dollars put in circulation, how many dollars are out there, what interest rate is charged, where there is nobody in charge of, and we're going to start predominantly with Bitcoin. Now, what it is in the development and the blockchain and the creation of Bitcoin, all of this is predetermined in code that cannot be changed by any human being. Can't be hacked, can't be changed. It's all highly encrypted. So all the things that would go into traditional currency have been pre-programmed into the digital asset. So therefore, it is self-regulated. Now, we're not talking about, there's a difference between self-regulated and regulated platforms. Like Alvexo is a regulated platform. That means they have the government licensing requirements to offer trading to you. It means that they're watched, they're supervised, and they have specific rules and regulations they must follow. There is no regulatory authority over the issuance of currency except for the central banks. And because there's no central bank, so furthermore, the process is powered via the internet, with users within associated networks providing the verification that enables the transaction to occur. Okay, and like I said, we're not going to go into miners today. We're not going to go into encryption today, and we're not going to go into nodes today. But similar to Forex, there's no, now, the currencies, the euro, the dollar, are issued by the central bank, but currency trading, forex trading, there is no central clearinghouse. It's a set of net computers around the world that connect together. It's not like the New York Stock Exchange or the FTSE. Okay. Now, in the case of cryptocurrency, there are a set of network, which we call miners, which I don't want to discuss today, that crack a encryption code to verify all of the all of the transactions, so to speak. And then once it's cracked and approved, that actually and it's all numeric in all computers, all of this is sent out to all of the nodes all throughout the networks. Everybody that's part of this network, not you and me, because we're not a node, we're not a miner, okay? We're not cracking anything. We have wallets. And when you move your money from your wallet to somebody else's wallet, it has to go through this network. Okay? But unlike Visa and MasterCard, which has one network and is owned by Visa and MasterCard, nobody owns the Bitcoin network, and everybody has a complete historic ledger of every transaction that happened. So that means that somebody can't fudge a transaction on their platform and get away with anything, because all the platform or all the nodes have to agree on a transaction. Okay. And this was what provides some of the safety. So the genesis of what we know as cryptocurrency transpired back in 2009. And it all began with the launch of Bitcoin. And this is the proto cryptocurrency, the big daddy of it all. So there's Bitcoin and altcoins. You have Bitcoin and altcoins are all the other coins. Now we can't get coins and tokens mixed up because they're also different. Bitcoin was originally proposed as an electronic payment system based on cryptographic proof. The cryptographic proof came from emerging technologies of blockchain. A kind of a list of digital signatures provides computational evidence describing the entire transaction of each Bitcoin. The public chain of ownership allows peer-to-peer transactions without any need to entrust the third party with the task of payment processing. This lack of any kind of third party operating in a single supervisory role means that Bitcoin is a decentralized digital currency. Back in 2009, some market commentators dismissed this new virtual currency as mere fad, a transitory reaction to a subprime crisis that had racked the global economy back in 2008. But as Bitcoin has grown in value and credibility over the years, interest in this new type of currency and this new technology framework that underpins it has blossomed. Now, again, I'm not here selling you or trying to get you interested in owning Bitcoin or being part of the Bitcoin community, okay? But you have to understand a little bit about where they come from in order to trade them. Not exchange them, but to trade them in a CFD format, just like you trade the euro dollar. You trade the euro against the dollar. You need to know what we expect the dollar to do, where the dollar comes from. You need to understand what the central bank may do, what James Powell might do. He might raise interest rates, decrease interest rates. You need to understand this. So in cryptocurrency, you need to understand what makes it tick, so to speak. As more investors have embraced Bitcoin over the years, its value has been driven higher, which in turn has driven greater interest in the asset class. This has led to a breathtaking increase in value and volatility. Now, all cryptocurrencies are based on supply and demand. Most cryptocurrencies have way more supply than they do demand, but all cryptocurrencies have a supply limitation. With Bitcoin, it's 21 million Bitcoins. Okay? Because unless they have a no more to be issued ever guarantee, the asset has no value. Because if somebody could just push a computer and issue more Bitcoins, it would always go down and down. It's no different than a stock of a company. when a company goes public, they can't just keep issuing stock, because the guy who bought the stock in the beginning, he was promised there was only going to be 10,000 shares of Google, and his value is based on 10,000 shares. Now, Google can break down a share of Class A stock and make 10 shares of Class C stock, which equal one Class A stock. Okay, but they can't issue more of that primary share. It's controlled because, again, without supply and demand, without a guaranteed value, that you're not going to be liquidated by somebody issuing more. And this comes into play when we talk about trading Bitcoin, because as Bitcoin became more and more popular, or cryptocurrency became more and more people came into the marketplace. Whether it was when it hit 20,000, making all the headlines in the newspaper, and grandma, who doesn't even know what this stuff is, got interested because, not because she wanted to trade cryptocurrency, she wanted to buy, she wanted to be a cool grandmother. She decided to buy one. Who wanted to find out how to buy them because she wanted to give them to her grandchildren as a Christmas present. Okay. This means more demand. All of a sudden, she's buying 3 coins to give to her grandchildren, and there's 3 more or 4 more players in the market buying up things. Well, the more people that are buying a limited source, regardless of what they're buying and why they're buying, increases demand, drives up price. Okay. And cryptocurrency is all based on this drive. It's not based on earnings reports. It's not based on stock issue. It's not based on Donald Trump. It's not based on jobs data. So 2017 proved to be a remarkable year for Bitcoin and cryptocurrency market in general. Having never been above $1,000 before 2013, Bitcoin broke above $6,000 in October, and by early December had rocketed above 10,000. By the end of that month, it set a record of 19,783. Why? They weren't selling more TVs than anybody else. They weren't outselling iPhones. They didn't have more subscribers to their YouTube channel, and they hadn't hit gold. What they hit was bigger social media communities, bigger public interest, more news, more people like grandma jumping into the markets. And when this happened, all of a sudden they started becoming interesting, or the talk of the town, to bankers, to investment houses, to government agencies, to the SEC, to the FCA. Okay. And every day somebody's talking, they're making major headlines. And now when major governments, even though a lot of governments were anti them, they were talking about them. When stuff gets up that they're talking, the lips of regulators and central bankers and investment bankers are Warren Buffett even mentions them now and then. He doesn't like them, but he mentions them now and then. Well, that brings more interest. So the volume of Bitcoin futures contracts grew steadily in the months after the launch, offering greater and greater liquidity to traders. The price of Bitcoin fell into a persistent downtrend, and by February 2018, Bitcoin had plunged below 6,500. Okay. Now we say that's horrible. It was only trading at $1,000, went to 35, went to 65, went to 19,000 in days, and then came back down to 6,500. It found a new level. By December 18th, that value had shrunk to 3,500. So this was the new acceptable level for Bitcoin. It went from $200 up to $600. Then it found a new place at 1,000, found a new home at 35. Just because it jumped up and down in between, it still has to find its new level. Today, that level is about 10,000, 9,500. Okay, and we're seeing it come out to a new place where it steadily goes to. So also in December, the crypto market's market cap plummeted from just under 180,000 to 152 billion. I'm sorry, 180 billion to 152 in a 24-hour period, with many speculators comparing the major crash to the infamous .com crash in the early 90s. These are lots of people who just like to talk. What it was lots of people made lots of money and they sold, and pocketed their cash. Now, Bitcoin was by far the earliest cryptocurrency, arriving more than 2 years ahead of the second cryptocurrency, which was called Namecoin. Hasn't done much. The success of Bitcoin has led to a massive proliferation in digital currencies. Right now, today, we have over 1,100 digital currencies. But virtually none of them have any volume, have any exchange, because without an exchange, without any volume, without any interest, they're just things that were issued out there. They're like penny stocks of the old day. So one of the most interesting aspects of these new cryptocurrencies is the lack of control by any single body. Traditionally, fiat currencies are governed by central banks that may operate independently of the national government or at behest of the government. Now, the question is, now that you know a little bit about them, why trade CFDs on cryptocurrencies? Cryptocurrencies are made possible by the emerging technology of blockchain, the public ledger that keeps a record of all transactions. And since the outset, the potential of both of this new type of asset and the technology is, in general, has endangered interests of specialist quarters. There are a few advantages and disadvantages connected to trading CFDs on crypto compared to regular cryptos, and traders sometimes get confused. Now, you can remember, you can't buy Bitcoin to put in your pocket. You can't walk around with it. You can either own Bitcoin in the digital sense and own them. So I own a couple Bitcoins. They're in my wallet, not my pocket wallet, but my digital wallet, and they're mine. Okay, their value is based on the current market value, just like my shares in Google. Okay, they're mine. They're put away in my portfolio, and they go up and down in value. But I don't owe any money on them, and I'm not trading them. They're just sitting there, and whatever today's market price is, I don't really care. It's just when I go down the road, if I ever go to sell them, but they're mine. Now, because you hold them in a wallet in a digital format, many exchanges, and that's where you have to go buy these digital currencies, because the exchange has to hook up a buyer and seller, like basically like Wall Street. If you want to buy stock, there's got to be a seller and a buyer, and the value is based on the consensus between the buyer and the seller. Same thing in cryptocurrency, and the method of doing this is through an exchange. Now, this is one way. Now, some exchanges will offer you what they call margin trading. If you have one Bitcoin, okay, so you have your wallet where you store them, then you have to put them in an exchange to trade them, to exchange them with somebody else. You want to get cash for it, you decide I want to go over to Monero or to Litecoin. You got to do this through a platform. Somebody's got to handle the transaction. Now, the exchange platforms want to also make profit. Okay. They can do this by offering you what they call leverage. They usually allow you, if you want to just trade, they'll allow you to buy 2 Bitcoins for every 1 Bitcoin you have in your wallet. Okay. Via a margin loan situation. Okay. And this is called margin trading. It's almost like you can do with your stock and with your broker, because we know Bitcoin's not going to drop from 6,000 to $0. Okay. But this is a limited aspect, and a lot of people do this way. But then you have to have a wallet, you have to have an exchange, you have the thing with hacking, and you have all the other things, and you have to convert, and you have to get fiat currency, all of this stuff involved. You have to pay for it with your credit cards, and complicated. But the other option is trading a CFD, a contract for difference. But this is where people get confused. In a contract for difference, you have an account with a broker's platform. Okay. In this case, we're here sponsored by Alvexa. So say you have $10,000 in your deposit account at Alvexa. You don't have to do anything different, because when you decide you want to trade cryptocurrency, you're just doing a contract with the broker, because you're not actually taking possession of this digital asset. So you don't have to have a wallet. And you can buy portions of a Bitcoin or a cryptocurrency. So most of those confused traders are crypto enthusiasts who try to drive the market as well as pocket some profit in the process. So contracts for difference trading, otherwise known as CFD trading, is a method that enables individuals to trade and invest in an asset by engaging in a contract between themselves and a broker instead of opening a position directly on a certain market. Okay? Whether you're trading Forex, whether you're doing stock trading, whether you're trading oil or gold in a CFD format, it's all the same. Same account, same broker, same everything. The trader and the broker agree between themselves to replicate market conditions and settle the contract amongst themselves. So in other words, even though you're not owning the gold, or in this case, the Bitcoin, the value of the contract mirrors the actual cash value of the asset. So your contract is based on whatever Bitcoin is in the real world. Now, CFD trading offers many advantages that don't exist with direct trading, such as access to overseas markets, leverage trading, and short sells. CFD trading is the only way you can sell a cryptocurrency if you think it's going to go down, to buy it back later at a lower price to make profit. Because a contract is based on the difference between the opening price and the closing price. And if you sold it, doesn't matter what happens in the middle. You open it with Bitcoins at 10,000, and what you did is your open position was a sell. You sold Bitcoin at $10,000. Later in the day, you bought Bitcoin back at 5,000. So at the end of the night, when it had to clear out, or clear it out, you bought it 5,000, you sold it 10,000, you made $5,000. Okay. Or the reverse, it's easy to understand a long sale. You bought at 5,000 as your opening position, but see, you got to not confuse open and close. Open is the first step. It's not mean buying. It means opening your position, whether you're selling first or buying first. And then closing is always the exact opposite of what you did first. So I'm going to show you a little prepared video that's going to explain CFDs to you in a visual format, so that you have a better understanding. And then we're going to talk about trading cryptocurrencies, and then we're going to take a look at my charts from this morning on the majors. And this is a very short little presentation.
Including shares, currencies, stock indices, commodities, and more. What is a CFD? A CFD is an agreement to exchange the difference in value between the price of a contract when it is opened and the price when it is closed. This means CFD trading, depending on your position, allows you to profit if the value of a share, for any market, moves down as well as up. And as you are only trading on a price derived from the underlying market value, this means you never actually own the share or asset, which can make it cost-effective. How does it work? Each share or asset has a buy and sell price, known as the bid and the offer, which is derived from the underlying market. If you think the market will rise in value, you buy at the offer price, called going long. If you think the price will fall, you sell at the bid price, called going short. The more the market moves in the direction you predicted, the more profit you make. The more the market moves in the opposite direction, the more you could lose. It is up to you how long you keep the trade open. What markets can I trade on? CFD trading isn't just limited to shares. You can trade on a huge range of financial markets from all around the world. Stock indices, exchange-traded funds, and many more. Do I need a deposit? CFDs are leveraged products, meaning you only have to deposit a small initial percentage of your overall exposure to a market. For example, let's say you want to trade 10,000 shares in a big company. With traditional share trading, you would have to buy 10,000 shares at the full price. With a CFD, you only have to put up a small initial payment, as low as 10% of the total value. It's important to remember the risks of leverage. As your deposit is only a small part of your overall exposure, you can lose substantially more than your deposit if the trade goes against you. However, it is possible to reduce your potential losses by using a stop order. This means that a trade will automatically be closed if it goes against you by an amount you specify. What are the costs? In addition to your deposit, to open or close a CFD trade, you may have to pay a small commission, which can be as low as 0.1% for shares. Other markets, such as indices and foreign exchange, are commission-free. You may also have to calculate interest adjustments that are added or subtracted from your trade if you hold the trade overnight and consider any dividend adjustments. An example trade. The price of big company shares is currently $4.99, $5. You think the price will rise and want to trade 5,000 shares, so you buy at $5 for $25,000 total exposure, paying a 10% deposit of $2,500, which is the initial margin requirement. You pay 0.1% commission to open the trade. 5,000 shares times $5 per share times 0.1% gives us a commission of $25. It's near the end of the day and big company shares have risen to $5.10, $5.11 and you decide to take your profit. You sell 5,000 shares at the sell price, $5.10, and pay a commission on this example of $25.50. So your profit is calculated as follows. The opening level of the trade was $5. The trade was closed at $5.10, giving us a difference of 10 cents. 10 cents times 5,000 CFDs bought is a profit of $500. Costs of $50.50 with the commission, so our overall profit on the trade after costs is $449.50. CFD summary. CFD trading is a flexible alternative to traditional trading, with access to a full range of financial markets, and allows you to make money when markets are rising or falling. You don't have to put up the full cost of your exposure to the market, and there is no fixed time period to your trade.
Now, I need to mention one of the most important features of trading CFDs is leverage. Okay. It used to be, not so many years ago, it was the Wild West out there, and there were brokers all across the world offering all types of leverage, 500 to 1, on not just cryptocurrency, on stocks, Forex, commodities. Well, in the last few years, the global regulators have reined that in. And since almost everybody is regulated today, and of course, Alvexo is a regulated provider, the margin and leverage available, and it's a flat number to everybody. It's not based on your credit scores or how long you've been trading or how much money you make out. These are completely controlled by the regulator. Cryptocurrency today is the maximum of 5, I believe it's 5 to 1. Okay. And the deposit requirement is, again, specifically based on the regulator. And everybody is the same. Okay. So therefore, you can't hunt leverage and you can't hunt margin. Now, your margin requirements, your down payment. There's no cost to you, so to speak. It's got to be, it's what you're putting down, but there's no charge to you at all. Okay. So in other words, if I wanted to buy $10,000 of something, I'd have to have 10% of that value in my account, or $1,000. They would hold my $1,000 and I would owe $9,000. And when I close that trade, I would get back whatever whatever the value was. If it was 10,500 minus the 9,000 I owed, I'd walk away with 1,500. So margin is simply a deposit requirement. It's not a fee. It's not money that's taken from you and or paid to a broker or a commission. It's just a down payment. Now, what about CFD tradings for cryptocurrency? Cryptocurrencies have also begun to generate a lot of interest as an alternative investment, or CFD. A large part of this is down to the headlines generated by the huge leaps in Bitcoin's value. As the price of Bitcoin began 2017 worth around $1,000, a rocket to more than $19,000 by December of that year, when prices moved quickly, traders started to pay a lot of attention. Many people gain an exposure to cryptocurrency by simply putting money into them, that is, buying the actual digital currency. There are downsides to this, however. Processing times for buying a cryptocurrency are slower than the instant fills with a typical Forex trade. There are unregulated, and there have been scares and stories of compromises and hacks of Bitcoin wallets and Ethereum wallets that are associated with exchange platforms. I don't know if there's ever been a hack of a wallet, so to speak, an independent wallet. There's hot wallets and there's cold wallets. Like, I store all of my coins in a wallet that's not associated with a broker or platform or anything else. It is like the vault at the bank. It's like the safe deposit box. And in order to hack it, you'd have to break into my specific account with my specific passwords and my specific keys. And out of my 3 Bitcoins is not enough for your time and effort of a hacker. They'd have to hack each individual account and be able to get away with it. Where so they hack. There are also wallets, which are really what you could call your accounts on exchange platforms. And exchange platforms, you have to have the coins there in order to exchange them. So you're holding them, and they're really a wallet on an exchange platform. Now, they've gotten a lot safer. We actually have a physical individual wallet that's from that platform, and it's tied to it, but it's still an individual private wallet. But when you read about all these hacks and all this Bitcoin disappearing, it's gone in a fell swoop. 100,000 Bitcoins, 50,000, and that means because they can break into the exchange and suck everything out of everybody's wallets, because technically they are sub wallets of a larger wallet. But you don't have that at all when trading in a CFD format, because you're using the same account you have with the same dollars you have in that CFD account. Now, you can easily sidestep all the concerns by trading cryptocurrencies via CFDs. Using CFDs allows very fast transaction times, which is useful for very volatile markets. The price of Bitcoin has jumped up and down since it first entered the mainstream consciousness in 2013. That year, prices rose by almost 100% before the collapse of Mt. Gov, and the biggest online Bitcoin exchange at the time sent it crashing. Now, we're not going to talk about Bitcoin as a currency and does it work well and how does it work out there and is it worth having? Okay, we will talk about the Bitcoin volatility and making money. I have one client who is in cryptocurrency who I do work for, and we agreed that they could pay me by Bitcoin. Well, a couple months ago, Bitcoin was at $7,000, and I invoice them in dollars, and they pay me by Bitcoin. Well, I left the money there, and those Bitcoins went up to 9,800. Okay, last week went up to 10,005, came back to 98 today, but he paid me at the value of $7,000. Sure, if they fall lower, that would be a problem. But let me share with you a little presentation on trading CFDs with crypto. So now what affects the price of Bitcoin? Because in order to trade, you have to understand what's going to affect it minute by minute, day by day, hour by hour. Well, Bitcoin, since it's not part, or not Bitcoin, but cryptocurrency, since it's not associated with the government, its community or its digital, or its government leaders and its you know headlines and everything comes from social media. So it's affected greatly by these communities and social communities. Also, news headlines, as well as whales taking big moves or making broad statements about the currencies. Now, the majors are Bitcoin, Ethereum, and Ripple. The only three I consider trading at all. Okay. Then we also have Litecoin, which is fairly popular, but it doesn't make enough reaction. So let's take a look real quickly before I say goodbye to you on today's charts. Now, I do my analysis for my client first thing every trading day so that they can post it and the traders can understand what we expect in day. So here we go. It's today's chart on Bitcoin. Now, I firmly believe that you don't need a lot of technical jargon. I use support and demand, historical prices, and moving averages. And you can see in here all of these colored vertical lines on my chart are what we call levels of support and resistance. These are price levels in the past when Bitcoin has been at this level, where the prices had a problem moving up and down. Okay. And we go back on these for a long time flat, but you can see this price here has been a strategic price. This price here has been a strategic price. And we go back farther and farther in history. But look, as we move forward, we see how important that level is. We see again all the congestion. And we see today when it fell all the way down to 9,700, it bounced back to that level again. Okay. Now, we see our resistance level when it climbs up, another level that was important. And so therefore, this is the trading range today. Okay, here's our long-term trend line. So we can do this. And so Bitcoin and Ripple and Ethereum do very well for simple chart analysis without complex algorithms and stuff. Very easy to see. You could have predicted the entire move of Bitcoin climbing from 7,000 all the way up to 10,005 easily without being very complicated. Here's Ethereum. Now, Ethereum went hog wild. Okay, it shot up over the last week. Okay, all the way up to almost 300. Couldn't break that 300 level. Fell back down, and it actually fell down, which we know from Dow theory, 50% of its level, and then started returning upward. And we can see the prices that were strategically important. And then we've evaluated today's trading range, and we're a little bit higher than that. So what we were looking at is it broke above this level here, and we were looking for it to come back down into here. And then lastly, we have Ripple. Ripple soared from the 11th of the month all the way up, okay, almost to the 30 price. Hit 30, and what did it do? It reversed over the last few days and came back all the way down and gave back exactly 100% of its gains. Okay. Bounced off of that 100% level, which you see here. Okay. Now, if we're trading a CFD, these are 1 hour charts. So this is what you would be trading using a CFD. Here we see it bounce off the 100% retracement level, and we see it break through its next resistance level. So we could have predicted this move right up here easily. Here it broke through this support level, came right up to this resistance level, went through, and this is where we were trading this morning. And we were expecting the range to top out here and then fall back down somewhere throughout today's session down to this level, where we could have entered a short position somewhere around here when it bounced off resistance. And whenever it got close to this level here, sold. Because the nice thing about CFDs is we can keep them open for the next day, or we can close anytime we want. So there's a lot of choices for you to trade in a CFD format to trade the major cryptocurrencies. And you also can trade them not just against the dollar, you can trade them against the euro, and you can also trade them against other coin values. just like you would be trading in Forex. You could trade the dollar against the pound or the pound against the euro. Okay. But it offers a new opportunity for a good, solid investment. So thank you very much for joining us. Have a great trading day. If you have any questions, go to www.alvexo.com, ALVEXO, and they explain this in great detail, or you can talk one-on-one with one of their cryptocurrency experts. Have a great trading day. And again, thank you for supporting Alvexo and investing.com.